Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 53, titled In the Money Cash Secured Puts. Allow exercise or roll the option when using the PCP strategy. And we're going to use a real-life example with Intel Corp, which trades on the NASDAQ exchange under the ticker symbol INTC. Let's first define the PCP strategy, or put, call, put. Some people refer to this as the wheel strategy. Now, the PCP strategy starts by selling an out-of-the-money cash secured puts. So we're selling a put strike below the current market value of the stock. As the option seller, we are then obligated to buy the stock at the strike price, again, lower than current market value, by the expiration date. We set up the strike and the expiration date when we sell that put. Now, if the price of the stock moves lower below the put strike, then that strike is said to be in the money and subject to exercise. So the question is, do we roll that option to the next month, avoiding having to take possession of the shares? Or do we allow exercise, take possession of the shares, and then write a covered call as described in this PCP strategy? So step one in the PCP strategy is to sell the out-of-the-money cash secured put. If the price of the stock drops below the put strike and we take no action to roll that option or buy it back, then we do take possession of the shares, and now we can write our covered call. So what we did by selling the out-of-the-money cash secured put is to purchase the shares at a discount, or much lower than the price of the shares when we entered that put sale. Now we write the covered call, could be in the money or out of the money, and if that call option is exercised, then our shares are sold, and we then use the cash from that stock sale to secure another put, and on it goes. So every month we're either generating cash flow in the form of option premium, or we're buying a stock at a discount. Of course, we still have to manage all legs of the trade, but in essence, that's what we're accomplishing with this PCP strategy. So mastering both covered call writing and selling cash secured puts allows us to create this multi-tiered option selling strategy. Now, as far as our management choices are concerned, when the put strike is in the money at contract expiration, there are several things that we can do if the price of the stock does in fact drop below the put strike. We could buy back the short put and move on to another put trade the following Monday. In other words, we've had it with that stock. And we use this approach if the underlying security no longer meets our system criteria, which of course is based on fundamental, technical, and common sense analysis. Or if there's an earnings report coming out the following month, we don't want to have that stock as a basis of any option sale. Or if the calculations simply do not meet our stated goal. For me, it's 2 to 4% a month and up to 6% in a bull market. So that's one choice, to buy back the short put and to move to a different security or a different underlying. Second possibility is to roll the put option to the following contract month. When would we do that? Well, we would favor this approach if the stock still does in fact meet our system criteria, but the overall market conditions lean bearish, and therefore we're unlikely to sell an out-of-the-money covered call. And of course, having that ability to sell out-of-the-money covered calls, generating the possibility of two income streams, one from the call premium and the other from share appreciation, is the advantage that covered call writing has over put selling. So, but if it's the overall market leans bearish, we probably will not want to write an out-of-the-money covered call, in which case, why not just roll the put option to the following month as long as it meets our stated goals. So that's the second possibility. The third is to allow exercise of the put to take possession of those shares and then write a covered call against those newly acquired shares. This is the call leg of the PCP strategy. Now, in favorable market conditions, we can then write an out-of-the-money covered call, thereby creating an opportunity to generate two income streams per trade, one from option premium, one from share appreciation. So those are the three possibilities when we're using the PCP strategy and the price of the stock moves below the put strike. Let's go now to a real-life example, a one-month return for Intel Corp. When we originally sold the 44.50 put, what would it cost us to buy it back? So as expiration is approaching, we go to the ask column because we're buying back the put. We sell at the bid, the lower, buy at the ask, the higher. In this case, the ask price for the 45.50 put would be 97 cents. Question is, how much can we generate by rolling out to the 45.50 put for the next contract month, 1 month later? And the answer is, we turn to the bid column now, and that same 45.50 strike generated $1.80. So we have a credit of 180 and a debit of 97. If we were to work the calculations, we would see that if you take 180 and subtract 97, we would have a credit of 83 cents per share, $83 per contract. Now, how much cash would be required in the next contract month? Well, the put strike is again 44.50, and the put premium is $1.80. So that would represent a net of $42.70. That's how much per share a broker would require for the next month trade. So if we took 83 and divided it by 42.70, that would represent a 1 month return of 1.94%, almost 2%. So pretty close to a 23 to 24% annualized return. It's very significant. So if that meets your stated goals, and if we still like Intel, we roll the put option. Let's take an overview now of this podcast. Management of in-the-money puts when utilizing the PCP strategy includes closing the short put and using the cash to secure a put on a different stock or ETF. Again, if the stock no longer meets our system criteria, or if there's an earnings report. Now, rolling the put to the next contract month is a possibility, especially if the overall market conditions are not favorable for then writing an out-of-the-money covered call. And the third possibility is allowing exercise as part of the PCP strategy and then selling a covered call, hoping to be able to use the out-of-the-money call to set up an opportunity to generate two income streams per trade. So these decisions are based on the overall market assessment, calculation returns, and of course the trade adhering to all of our system criteria. We must have a structured system, and once we have that and we abide by it, making all these decisions becomes so simple. Okay, folks, as always, I want to remind you of all the free resources we have on the Blue Collar Investor website. If you click on the free resources link, you can download the basic element calculator. We also have a single column put calculator and many other files related to option selling. We have over 400 articles available to you. Use the Google search tool on our web pages, on our blog page. Go to our free newsletter, sign up if you don't already receive it, and you'll get our free newsletter every Sunday morning, 10 a.m. Eastern Time, delivered to your email box. And I spend hours a week writing these articles, and they all have a very important educational component to them. Also visit our store, the bluecollarinvestor.com/store. Take advantage of our best-selling books on covered call writing and put selling. I also have a book just on financial literacy called Stock Investing for Students. We have those books in PDF format, hard and soft cover. Some of them are in hardcover format. Video lessons, online streaming DVD programs, calculator spreadsheets. We have a trade planner as well as online mentoring programs. So have a look in the BCI store as well. So ends this BCI podcast number 53. I want to thank everybody for taking the time to listen to this podcast. I hope you enjoyed it. And more importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.